Hello, everybody. Welcome to the Like a Tortoise channel. Happy Tuesday to every single one of you, dear viewers. Boy, is it boiling right here in London, almost 35 degrees at the time of this recording, which is absolutely insane. I know several of you are also based in London, considering the fact that several of you have become clients over the last few months, for which I'm deeply grateful. But needless to say that we have been boiling over the last few days. This is crazy. So anyway, a long story short, today I want to talk about quality investing and whether or not quality investing as a strategy, as a philosophy is dead. Needless to say, I take the opposite view. I don't think quality investing is dead whatsoever, and I will explain everything that you need to know. But before I do that, I want to say big thank you to all of my dear subscribers, and for those of you who are new to the channel, welcome. Hopefully, you'll find a lot of value from the videos that we will continue to put out going forward. And if that is the case, and if for some reason you cannot or want, or if you cannot or don't want to become a client for any reason, then anyway, just make sure you spread the word by sharing the video with other people so that they can benefit from what we are doing right here. And also, guys, applications for June are open. I provide a coaching experience, a very personalized one-to-one coaching experience, which means that I can only onboard X amount of people on a single year, every single year. And if you want to understand whether that is you, then you just need to just go to my coaching program website, which you can find right in the description below. It's right the first link, and you can jump on a call with me, and we will see if what I do can benefit you whatsoever. Even if that is not the case, and if we end up not working together, I will still map out a game plan for you that is actionable, so you can start implementing a lot of the things that we discuss here at length over or like into the future. Okay, so guys, let's talk about quality investing. And the first chart that I want you guys to take a look at is this one that I already discussed, I believe, a few months ago. But this pretty much summarizes, it certainly sets the tone for the rest of this video. And what you can see right here, everybody, please pay attention, because I think there are so many. Just, I think, let's just say that if you have the right framework, there is no way you are not going to make a lot of money over the next few years. Let's just put it like that. This is, as you can see, this was put out by Bloomberg on October 31st, 2025. And what you can see right here, it's a very easy to read. You can see that quality stocks have been underperforming the most since 1999. And we all know what happened afterwards. I'm not saying that what we are seeing right now is a repeat of the late 90s and early 2000s, the moment that was famously known as the dot-com bubble, as we all know. But what I am saying right here, guys, is that what I want to emphasize, the point that I'm trying to make here is, number one, quality is at the lowest, at the cheapest valuation relative to the index since 1999. That's one thing. And number two, you can see that quality stocks typically perform over time. Typically outperform over time. That makes a lot of sense. Now, quality means different things to different people, but we all have to agree on a few metrics here. So, what exactly do we mean by quality stocks? Quality stocks are stocks that typically achieve better than average returns on invested capital. We are talking about companies that are, number one, profitable, companies that have displayed growing revenues, growing profitability metrics over the last several years, and so that they meet several of these quality criteria, which makes sense, and therefore it makes sense for them to be categorized as such. And what we are seeing right now is this wide discrepancy. And what I want to say is that I don't believe that this discrepancy will continue forever. Okay? So if you agree with me, if this makes sense, then it stands to reason that there are many great companies at attractive at there are many attractive companies today in the market, and they are trading at one of the lowest valuation ever in the history. All right, and those are the companies that we already have on our watch lists, and many of them are also in our portfolio, and we believe that they will continue to outperform. And I'm going to show you exactly how. And another chart that I want to show you right here, and I have plenty of them because, as always, I'm very data driven. I'm also a visual person. And what you can see right here is that you can see what happened back in 1999. And you can see how Berkshire Hathaway underperformed the S&P by a staggering amount in 1999. This was the time when the media was calling Buffett outdated. They were saying that, and you can look this up. I'm not. You can look this up on Google. I'm certainly not making it up. But they were asking this question. I think this was a piece of news put out by the Wall Street Journal, asking whether Buffett had lost his touch. I kid you not. Needless to say, what happened in the subsequent years. But yeah, even Berkshire underperformed. Look at this. They were down almost 20% versus 21% for the S&P 500. This is incredible. Absolutely incredible. A 40% difference, as you can see right here. And I believe we are in a similar situation. I believe that sooner or later, this gap that we are seeing today in the market will narrow, and quality investors will make a lot of money. Now, I want to make another point here. And if you have been following this channel for a while, then you know this for a fact. I'm not a quality investor at heart. Terry Smith, and I believe that most of you already know this name, is a quality investor at heart. So they buy high quality companies at what they call reasonable price. I don't want to pay anything like a fair value. I don't want to do that because I know that in the stock market, sooner or later, no matter how great the quality of the business, they go through periods of uncertainty, and that's when the value drops far below what we deem to be the real value of the companies. And that's when you have a big margin of safety, and that's also when you should attack, provided the story and the thesis is not broken. So I'm a blend of quality, and also I have a combination of quality and value investing characteristics. Quality because I seek the highest quality companies, but value because I want them to be trading at a price that is below what I deem to be their real value, so that I have my 50% margin of safety. As simple as that. What does that mean? Well, it means that you won't find many opportunities that check all these boxes in any given year. But I don't care because I'm a tortoise investor, and I know that when those opportunities come, that's when you should attack. In most of the time you will do nothing, and you don't need to be active most of the time in order to achieve phenomenal returns over time. And so my strategy is best suited for people. Number one, of course, want the best of quality at lower prices, but also people who are busy. They can go about their daily lives while still devoting less than 2 hours of their time per week. And that's just about all you need to achieve phenomenal returns. Okay, guys, so what am I going to show you right now as well? Something that I showed about, I think I recorded a video about 4 months ago discussing some of the metrics of my portfolio, and then I compared them to the S&P 500. Sorry, but it's very, very hot, so let me take a sip right here. I realize it's empty, not good. But okay, so you can see, I every now and then I like to compare the metrics of my portfolio uh, to those of the S&P. Why do I do that? Because I want to make sure that I continue to have a high. I want to make sure that the companies that currently can be found in my portfolio. So I want to be sure that my portfolio in aggregate has better quality metrics than the S&P 500. Why am I an active investor? To begin with, of course, if you are selecting individual companies, you want to outperform the average over time. Otherwise, what's the point? You just put your money in the index and that's it. I don't want to achieve an average rate of return. I want to outperform the average. So I want to make sure that the companies in aggregate, my companies have better quality metrics, and that's what I'm seeing right now. In fact, I've been seeing this ever since I started the Leica Totus portfolio. That has always been my framework. And what you can see here right now, everybody, is you can see some of my portfolio. So you can see how my portfolio contrasts the S&P across certain categories, namely capital allocation, profitability, historical growth, and valuation. So let's start from the very beginning. In terms of capital allocation, what you can see, and on the I have this table right here, and then on the left hand side, this is a screenshot that I took from stock analysis. And this, as you can see, is where I have all the metrics that you can find right here for the Leica Tortoise portfolio. So I'm not lying; they are very visible. And then what I did is I simply compared them to the S&P 500 metrics, and so I took a screenshot, and that's what you can find right here. So what we are seeing is, in terms of ROIs, which is, if you have been following the channel for a while, you know that this is my preferred metric of all, because it tells you how well the management team invests capital. In fact, how well the management team uses its invested capital so how well they use the invested capital how can I say, return on invested capital. So how efficiently they convert the capital that is invested in its operations to translate that into profits. That's what it means. So yeah, and you can see that ROIC of my portfolio is about 20.11% versus 10.20% for the S&P. That is practically double, everybody. So it means that the average company in the portfolio is far more efficient at using the capital invested in its operations, right? And they can turn that capital, so they can convert a lot of that capital into net operating profits after taxes, no PAT. And so that's what Royce is telling you. And if you look at ROI, which is the return on shareholder equity, you can see that we also boost higher ROI relative to the S&P 500. So from a capital allocation standpoint, the average company in the portfolio is more efficient at allocating capital, and this is what we want. In terms of profitability, take a look at this. The gross margin of our portfolio is about 55.83% versus 34% for the S&P, operating margin 18.89 versus only 12.10% for the S&P. So the average company in our portfolio boosts much higher operating margins relative to the average company in the S&P. Remember, margins are always a percentage of revenue. So you start with the revenue. For those of you who are new, we start with revenue. We deduct the so to achieve the profit margin, we deduct the direct cost, so the cost of sales. And if you do revenue minus cost of sales, you are left with gross profit. And if you divide gross profit by revenue, you are left with gross margin. The higher these margin metrics, the better, because the higher the percentage of revenue that is translated into profitability. And this is what we want. So after deducting all the expenses and taxes and interest payments, you are left with profit margin. And you can see that our profit margin is also higher relative to the S&P 500. Now, I want to make one thing clear here. One of our portfolio holdings, number one, we run a very concentrated portfolio. And number two, one of our holdings is Constellation Software. And none of these metrics make sense. In fact, they understate a company like Constellation Software because the company has a lot of amortization costs due to the nature of the business model. Remember, Constellation, they acquire businesses. And so, because they are a serial acquirer, they have a lot of amortization costs, and that will impact net income. It makes net income appear weaker than it actually is. And that means a company like Constellation Software shows a very low profit margin. So it's not accurate. You would have to use a different metric, but that is not currently reflected here. So the profit margin that sits at 15.41 would actually be higher if you account for that. Again, just a side note because it's important, because I run a concentrated portfolio, and that is impacting these profitability metrics, and that is not fair. So I just want to explain that to you, that this would be higher in normal conditions. Now, in terms of the historical growth, look at revenue right here. The average 5-year revenue for the company, for companies in our portfolio, is about 14.12% versus only 6.30% for the S&P. And what do we know, ladies and gentlemen? If I go right here, let me show you moat traits. Exactly. You can see this was also a piece of research that was put out by Morgan Stanley. What they found is that from 1990 all the way through 2009, top line growth was the driver of long-term stock market performance. You can see it was not free cash flow, it was not multiple expansion, it was not margin expansion either. No, you can see that it's revenue growth. Very, very important. So we want our companies to continue to grow revenue at rates more attractive than the overall market. And that is certainly the case. Take a look at this. This is more than double. More than double. Now, yes, it's important to know that historical performance does not guarantee future performance. But we all know, and if you don't, you should, that companies that have very good historical track records will have a higher probability of showing similar or better metrics into the future. So we are not trying to bet in the next big thing. We are trying to stick with high quality companies that are well established, that have proven business models. Look at the earnings per share 5-year CAGR, 21.30 versus 10.50% for the S&P 500. Staggering contrast. That's more than double, about double. And in terms of valuation, this is where the fun part begins. Look at the forward P ratio for the average company for our portfolio, 15.03 versus 21% for the S&P, and the current PE of our portfolio is 21.58 versus 32.90 times for the S&P. What do we know? We own high quality companies. In fact, I would say we own much better quality companies than the S&P, and they are also more attractively priced relative to the overall index. This makes me sleep well at night. And if your portfolio boosts similar metrics, then congratulations, because even though you may be underperforming right now, chances are that you will be very happy over the next few years. Because remember, anything can happen in the short to medium term. So I know, and I've been reading newsletters from very, very, great investors, and they have all been underperforming. So my portfolio, so the Leica Totus portfolio that I shared with you guys here, has also been underperforming in 2026 by a staggering amount. And what you can see right here let me go back right here. Look at famous investors and look at their performance relative to the S&P over time. Now, look, Fundsmith, Acre Capital Management, Berkshire Hathaway, Pershing Square Capital Management. This is the fund. This is the run by Bill Ackman. Pollen Capital Management, excuse me, and then you have the S&P 500. And look at how much they have been underperforming versus the S&P over the last 1 year, even 3 years, everybody, because the 3-year CAGR for the S&P is about 20%. And several of them, including Berkshire, only did about 15%. And yeah, and let's not talk about the year-to-date performance. I mean, take a look at that, right? Unbelievable. And this is already outdated. This is already outdated. So, but this is absolute. This is refers to 2026, but it's already outdated because it's a few months old. So anyway, you get the point. So some of the best investors in the world have been underperforming relative to the index, but what makes them outperform by a lot over the very long term is the fact that they stick to their guns. They know that the framework has been working for decades, not just 3 or 4 years, and sooner or later these markets will revert to the mean. And this PE that you can see right here, I mean, either the PE will come down, or the fundamentals of the average company in the S&P will have a lot of catching up to do. And I don't believe that will be the same. I don't believe that will be the case, because we all know that this has been one of the most highest concentrated markets in history. So when people believe they are buying uh, a piece of 500 companies, they are actually their money is actually being spread across 10 or 11 names, because it's a market, the index, the way it's a market capitalization, so it's market cap weighted, right? So it's not, unless you are buying the equal weighting index, you are investing in companies that have the largest market cap. And that's why today, and I was reading this to one of my clients as well this morning, you have Nvidia that already accounts like 8% of the S&P 500, which is staggering. Imagine what would happen to the entire market if Nvidia for some reason were to falter, right? If Nvidia crashed 70% because it has such a large weighting, that would in and of itself drag the market lower. I mean, let's not talk about the fact that if AI doesn't work the way that analysts are projecting it will work, then anyway, then that's when the rug will be definitely pulled out from under investors' feet. But that's a topic for another. That's a topic for another video. I just wanted to talk about quality in this video, and also to say that I'm very happy with the way we are allocating, and what we have been doing at Leica Tortoise is buying into weakness, if and or we have been adding to some of our positions that continue to get weaker by the day, and while the fundamentals are improving, because we know that over time, what matters is that revenue growth. As long as they continue to grow, the better. But also, many of our companies have phenomenal metrics in terms of capital allocation, profitability, historical growth prospects, and that makes me feel very happy. Okay, and so what's going to happen is, because they boost such high margins in many of these cases, then they will consolidate once the cycle reverses and all these high flying tech names come down. Then they will be able, because they are number one or two or three in their respective industries, they will be able to they will be able to either buy out their competitors, or and consolidate their market position, or or they will have less competition at the end of the cycle. And regardless of what happens, I think either in these scenarios, I think these will be very, very happy companies indeed, because that's what we saw, for example, after 2008. It's what we saw after 2000, and it's what we will continue to see after every recession, right? The strongest companies will only come out stronger, as simple as that. So, guys, I want to keep this. We are already a few minutes into this video, but this is what I wanted to share with you. I don't think I have anything else to share. Let me know. Oh, yes, I do have something else to share. I was reading this report as well by Morgan Stanley. This is already a bit outdated because it's from February the 4th, 2026, but they agree, and many individual investors also agree with what I'm saying. And of course, I'm in the space. I do a lot of due diligence, and I know so we are all in the same boat, in the sense that we all see quality underperforming, and I see a lot of people becoming desperate, and I don't want you to make silly decisions. And that's why, guys, you have to understand the companies that you own. Remember, we make decisions based on 4M's, meaning, moat, management, and margin of safety. Please understand the companies that you own, how they make money, who their customers are, what makes the company uniquely positioned in their space, what stops them from being disrupted in the next few years. And if you can understand the answers to these questions, you will feel more comfortable buying when the stock becomes cheaper. And that's it. That is the recipe for success. But you can see that Morgan Stanley, they talk about the fact that quality is on sale. And look, some of the highest quality companies in the world trading at an unusually discounted price versus the market suggests a generational opportunity to take advantage of quality on sale. But you can't do this unless you really understand what you are doing. Otherwise, you're going to end up messing things up significantly. I did that, unfortunately, because at the beginning of my journey, as many of you already know, exactly because I didn't have the right framework. And I had to invest in my education. And so, yes, this is what I want you to do as well. So take the framework. I discuss it at length in previous videos. And if you have doubts, you know exactly where to reach out, how to reach out to me. And leave a comment in the videos below if you find this video insightful. Thank you, everybody, and stay tuned for more videos. Have a lovely day.